Hey, everybody. This is your friend Wade Perry of the Perry Properties Group at EXP, and it is my distinct privilege and pleasure to welcome my dear friend Jared Hamilton of Cherry Creek Mortgage, part of Guild. And we're going to give you everything we can on today's mortgage market and how you can be best prepared to approach the mortgage industry or the mortgage process as we move forward into this market. A little background on Jared, because it's important to know who you're taking advice from. There are literally thousands of loan originators in Colorado, but there are only a handful that are truly exceptional that we trust our clients with. Here's a little background. Jared Hamilton is in his decade, fourth decade as a mortgage advisor. And I know it's surprising because when you look at him, he looks like he's still 25. He has helped over 2,500 families in terms of getting their home. He has originated over 1 billion with a B in loan originations. And he's in the top 1/2 of 1% of all the loan originators in Colorado when it comes to being a a 5-star rated professional. So I give this all to you, not to impress upon you, but to impress upon you that the gentleman you're about to listen to is truly an expert when it comes to being a debt advisor. And I think that's really what sets Jared apart, is that when you think about managing wealth, a lot of people think about managing the asset side, but if you're going to be truly effective at managing wealth, you must manage the asset side and the debt side. And that is one of the reasons why Jared has been our #1 and only mortgage advisor for the 17 years that I've been in the business, because he takes a holistic approach at helping the client in every facet of their financial life. So with that, Jared, welcome. We are stoked to have you on here, and we're even more excited to hear about what is the mortgage market, how do we get started, what advice you have for people. So let's start it with this way.
First, Wade, thank
Yes.
you. I'm super stoked because I'm also a Southern California guy. So that's a good 80s, 90s surfer term.
Yep.
To be here. And we talk a lot just generally, but I'm so excited to be here as a part of this podcast and this format to talk about how we can help people get to their overall financial goals. So thank you, Wade.
You bet. So, Jared, let's start in, because and just for the context of the meeting for everybody else, I really want to break this down into about 3 different major categories. And that is, what are the steps that people need to know about when it comes to obtaining a mortgage and buying a home? What are the mistakes that people make? And believe me, they make a lot of mistakes. And what are the myths? What are the misconceptions that are out there in the industry that are preventing people from taking that step to buy that house? So let's start with the first one. When you think about, the steps involved with obtaining a mortgage in today's environment, Jared, what's the first thing somebody should do?
Well, personally, I mean, I think one of the first things that people can do is really pick up the phone and talk to a mortgage professional that they trust. I mean, before that step is made, they should probably begin to really begin thinking about, okay, if they're wanting to buy a house, and maybe if it's their first house, why are they wanting to do this? Just to understand the big picture. Because if your why is fuzzy, then you're really probably going to have less of a chance of actually, moving through that process, because you're really not sure why you're going about it. I mean, are you wanting to buy a house for the intrinsic value of owning a home, because that's really important to you? Are you looking to do it more from an overall financial perspective? Are you looking to do it because that's what you just thought you should do? I mean, there's a whole host of reasons why people are kind of going through that process, and understanding that is super important. But then calling a professional who's done it and who can kind of help lead you through some of the important decisions that need to be made when it comes to getting a loan and using that loan to buy real estate, those are two of the first, I think, important steps. And getting engaged with a professional can kind of help them walk through the process. And then, talking to someone on your side of that transaction too, Wade, on the real estate side, that can then help incorporate that mortgage and the real estate goals all together to help them get to their financial goals. Does that make sense?
Yeah, and I think you really hit on something really important there that everybody needs to kind of listen to again, and that is, what's your why? The process of buying a home and the process of going through a mortgage, it's not scary, it's not hard, but it is something that takes a lot of work, a lot of effort, a lot of time, and it's so worth it. But if you don't have a really crystal clear why, then you might become disenchanted through the process and lose sight of why you're really doing this, and you won't go through with it. And then there was a bad taste in your mouth. So I think you really nailed it, is why do you want to buy a home? And
Yeah.
that then parlays into something you and I have talked about in the past, and it feeds into your holistic approach of being a debt advisor. Is what how important is it that somebody knows what their goals are?
Well, goals also do change. So, I mean, someone also doesn't need to, for sure know exactly what their goals are, but to have a general picture and a general target to
Sure.
shoot for is really, really important.
It could
Because,
be a particular house, it could be a particular neighborhood. Um, and how often do you talk to somebody and they've got goals and they're possible, they're not possible? There's some people that might think their goal is not possible. What do you say to somebody like that?
well, you don't know until we kind of peel the onion back and see. I mean, checking into it is the most important thing. Oftentimes, I talk to people who think that they are not ready, and surprisingly, they're from a financial perspective, they can buy a house and they just didn't know it yet. Or they think they may be ready, but maybe their objectives are misaligned with what is realistic. So they a lot of people go in thinking that they're going to buy their first home, and they might be thinking of the home that they lived in when they were a kid, and that's what their goal is. Well, the reality is that's probably not the first house that their parents had. And so
Sure.
so they have these visions of, okay, I want to find close to my forever home. But that may not be, that might be a couple steps later on down the road. And they got to first start with something that is a little bit more realistic to what they can do, and it gets them started sooner rather than just waiting till they can buy that forever home or they're close to forever home. Because that could be a lot further down the road if they don't get started now, and maybe make some compromises, and at least just start somewhere to begin building financial wealth, making it easier to buy that next home later on down the road.
Sure. So if I heard you correctly, and this is kind of trying to synthesize and condense it down, is that um, this is a great phrase that you started to lead into, and that is, if you don't know, you don't know.
Right.
And once you do, so maybe your goal is possible. And your comment was, most buyers that you talk to are more prepared financially to reach their goal than they thought they were.
Yeah.
Did I hear you correctly?
Yeah. Yes,
Okay, so
definitely. I mean, that's not everybody.
Everybody out there in TV land, if you think you want to buy your first home or you think you want to move up to something bigger, you're closer than you think, but you won't know how close you are until you sit down and talk to Jared.
Yeah.
The other thing that you really touched on, and I think I know where you're going to go with this, is people get stuck on, they want to buy their perfect home, their forever home, and they keep waiting to buy a home until they can buy that home. And it would be very, very difficult to save that much money for the down payment and wait until you have an income level that would support that payment, it could take 10 years, 15, 20 years before somebody got to be able to financially afford the perfect home. Am I hearing you right there?
Yes, and the reality is that there is no perfect home too. I mean, uh, everybody is always typically striving for something that's a little bit further out. I mean, I know I'm
Sure.
this way, is that I when I was 22 years old, I mean, I had some goals, and then uh now as a 55-year-old, because I do not look like I'm in my 20s. Thank you very much for that, Wade, earlier. But my goals are different now, and they've gotten maybe a little bit more uh, aggressive, or a little bigger. And so goals are always changing. And so most people too, even when they're what they think their perfect house is when they're 25, is totally different when they're 45 or 55. And
Sure.
it's always maybe a little bit out of the realistic reach, or everyone's looking for the perfect home, and there's just no such thing. I mean, we all have to make compromises in life. And so, again, talking with a real estate professional, a mortgage professional, and really kind of finding and understanding what the overall goals and objectives are, will help us figure out, okay, what are the really most important things, and what are we willing to live without or compromise on, because compromise is a part of life. And frankly, in Colorado too, values have gone up because this is a desirable place to live. There's more people who want to own a home here in Colorado than there are really homes available. And so that's a supply demand economics function that causes values to continue to rise. And that's a good thing overall. But if someone is just waiting until it is perfect, well, what we often find is that it just takes longer and longer and longer, because as homes appreciate, then the same house just costs more, and it's better to get yourself in, because every time someone makes a mortgage payment, they're actually paying down their loan. So they're building a savings account, and then they get to take part in the appreciation that happens as well. So they're paying down the mortgage in conjunction with taking advantage of the appreciation rates, and then they also are improving their overall tax situation likely. And as their income grows, they stabilize their overall housing payment, because when you do a loan, it's usually a fixed rate mortgage. And so the principal and interest portion is locked in. So they're stabilizing their housing costs, and they allow those other things to begin working for you. Whereas someone rents, then they're just the housing values go up, and they're not taking advantage of some of those other aspects of homeownership that cause people to have a higher net worth in the long run, because they've owned the home. And doing that sooner rather than later is a fantastic thing, because one of the myths is, you have to have 20% to buy a house, and you don't.
Right.
And for every $10,000 that you're able to save in today's current environment, which is rates being pretty high, that $10,000 only saves you about $70, $65 to $70 a month, which isn't huge.
Wow.
So yeah, usually getting involved and getting those other things working for you quicker does a much better job of getting you where you want to be later,
So it does not pay to wait, is what I'm hearing. And
generally.
these are all generalization
Yeah.
statements. But if I go back to, don't wait for your perfect home. It will take you way too long to save, given that appreciation of values is going to keep running away. But the best part is, buy what you can afford. And by doing so, values continue to rise over long periods of time. Every time you make a mortgage payment, you lower the amount of debt that you owe. So while the property value is going this way, the debt's going this way, and the gap in between represents your profit or your equity that years down the road, you are now going to take that and put it into the next house. So you buy a really good house now, and over time that gap widens. You take that gap and you can buy a great house. Fast forward another whatever 5 years, and maybe now there are children, whatever it is, and now that gap's widened even more because you bought a more expensive house, let's say, and now you're going to play that into the forever home. Is that generally what you think is what makes this go for most homeowners?
That's exactly what makes it go for most homeowners. And over
Okay.
the, we'll probably see this phenomenon again for those that purchased or refinanced maybe 3 years ago and got an interest rate that were in, closer to the threes. Those buying now are more than likely too also going to be able to lower their overall obligation when rates come back down too. I mean, so if you buy now, yeah, rates are a little bit higher than they have been before, but it's also very likely that they're going to come down. If they don't come down, they got the best rate that they could anyway.
Yep.
So it's a heads you win, tails you win scenario, because if rates do come down, now they can also lower their overall obligation and maybe pay down the mortgage even quicker because they were used to the higher payments, or take
Sure.
that money and continue to save and invest um, outside of the house and grow that corpus more, and just kind of let everything continue to work in their benefit. And meantime, they've had a place to live, which is great because,
I was just gonna say,
yeah,
whether you're paying rent or you're paying a mortgage, you're paying a mortgage. The question is it yours or somebody else's, right?
yeah.
And
And
for
whether
all of
you're
you out
paying
there,
a
oh,
7% interest rate now, or you're paying rent, which is 100% interest because it's somebody else. You're borrowing it, all of it
yep.
at that point. You're borrowing somebody else's place to live. So you're better off paying that 7% mortgage that you can deduct and gives you ownership than paying 100% interest, in my opinion. Typically, I
No,
mean, there
I
are
absolutely
there are times where it's better to rent, though.
I love that statement that when you pay rent, you pay 100% interest. And I remember you and I talked about this years ago. When you really break it down, when you pay rent, how much of your rent payment goes to principal? None. Therefore, the rest of it must be interest, which is all of it. So that is a really great point on you should buy something. And I actually will expand on that to say if you are not sure that you're going to live in a particular area, and when I mean a particular area, like the greater Denver area, I'm not specifying by a city, but if you know you're going to live in a general area for at least the next 3 years, my advice would be buy something, own something. If you're not sure of a 3 year time period, you probably shouldn't, because I have no way of telling you if the market's going to be up or down in 1 year or 18 months. But in
Yeah,
3 years, I got a pretty good idea.
yeah.
Let's take a moment and let's move to moving it on a little bit. What does it take? Okay, so now people are saying, okay, great. I accept the fact that I need to buy something and I'm going to buy a good home or a great home. I'm not going to buy the perfect home. And I know I need to have a conversation with Jared to understand, am I close to being able to afford what I want? So the next question is, what does it take for a buyer, even first time buyers, to buy a home in today's environment?
Well, so there's three main things that you need in order to get a loan. One thing that is probably the most critical is just okay credit. You need a credit score, and the credit score needs to be at least at a certain threshold in order to make the green light be there for a mortgage. Now, that threshold is not as high as a lot of people might think. Um, so credit scores, there's a lot of confusion or a lot of information around there or around credit scores. But when it comes to a mortgage credit score, which is a FICO score. So there's three main bureaus. There's Equifax, TransUnion, and Experian. They have multiple scoring models. There's what's called a Vantage score, which is the consumer score that the consumer sees. But there's an algorithm that's used to to determine the likelihood that that consumer will repay the mortgage. And that FICO score is calculated by each bureau, and we take the average of those, or at least the middle score of all three of them. And the credit score needs to be a minimum of about 580 for most programs, or at least the lower of the, or most, I guess I shouldn't say lower, but the most liberal of all programs. About a 580 credit score is where it needs to be. Ideally 620 or above, which is not perfect credit by any way, shape, or form. There's been some bumps along the road with those types of credit scores. So, but if it's below that, then it's we need to have some repair to those scores in order to get it to that level. But so it's a minimum credit score. You were going to say,
just real quick, what for all the viewers out there, what is perfect or close to perfect? What would it be a score?
Yeah, so the gold standard is a credit score of around 780. If it's above that, and a perfect score, and you can't get perfect, but when it comes to at least the time of this recording, 850 is kind of the highest possible score, but you can't get that highest possible score. But that's like the high end of the range, and then things are subtracted from there. I mean, having credit is required, but also having credit is a negative, because that means you may not make those payments. So that's why 850 is just not attainable. But 780 is like the gold standard or above.
Okay, so they need credit, right? And they need reasonably good credit. What else do they need?
You need credit. Then there's income, and then there is down payment. So the next most important thing is the income. And so what we look at from a mortgage standpoint is what we call debt to income ratio. So how much money does that consumer make? And what is their debt scenario? And there are certain ratios that we use in the mortgage industry. And the ratios are about 30% of the gross monthly income can go to a housing payment. And what we determine a housing payment would be principal, interest, taxes, insurance, mortgage insurance, and any HOA dues. Doesn't include things like utilities, cable bills, or anything like that. But what is the majority of the mortgage payment in principal, interest, taxes, insurance, mortgage insurance, and HOA. And then we allow the consumer to have debt. And so that debt would be revolving and installment debt. So it would be things like credit cards, would be revolving debt, things that can go up or down. And then installment loans, which would be things like student loans, auto loans, things that just have one, monthly payment that doesn't change. And so the total, what we call back end ratio, which is how much money does a consumer make and what are their other obligated debts along with the maximum mortgage payment, that would be a little bit over 40% of their gross monthly income. And we can stretch things like that afterwards. And then so that's income, and the ability to pay is the second portion. And then down payment, that would be something else. Now, a veteran, someone who is doing a VA loan, or there's programs out there that has no down payment possibilities. There's USDA loans, which also have no down payment possibilities. And a USDA loan is for rural properties. And then there's programs that we have out there that give down payment assistance. So like an FHA or a conventional mortgage, FHA minimum down payment is about 3.5%. Conventional mortgage would be 3%. But there are programs that we can add or we can that will allow for some assistance to meet that 3.5% or 3% down payment. So just the regular consumer could possibly get in with as little as $1,000 after closing costs and things like that. So it can be a lot lower than what people think, because it is a myth that a lot of people think, oh, I need 20% down. And so they're busy saving money to get to that 20% down, as values are going up and not taking advantage of owning a house because they think they need more than they do.
All right, so a couple quick things. And by the way, on that down payment side, there's always advertisements out there, no money down, 0%, blah, blah, blah. For the people out there that see those things and they're enticed by it and it gets them excited, what would you say to people like that? If your son or daughter, okay, if McKinley or Walker, glommed onto this and said, "Hey, Dad, what do you think?" What would be your guidance? I mean, you are a debt advisor, not just
Yep.
a mortgage guy. What would be your sage wisdom to people like that?
That's a great question, Wade, because there's conflict sometimes with these programs here because um, I don't want anybody to think that owning a house is out of their reach. I mean, that is something that is extremely important to me because that is something that is not the case, and I find it more often than not it may not be as far out of reach as people might think. But on the other hand, you need to go in to the homeownership decision with enough financial acumen and enough financial means to make sure that you're not doing something super cavalier because it is also a responsibility, just like driving a car or having a bank account or having a puppy, whatever it might be, those things come with responsibility as well. So there are programs out there that are geared for the first time buyer, and usually the biggest stumbling blocks is credit. So they'll be a little bit more forgiving on credit and helping to get down payment. Now, with that also, though, comes a little bit higher interest rate with those programs typically
Sure. You got to
because
you got to you got to pay for it somewhere.
there's no free lunch, right? And
No.
and the more you are financing, the higher your payment. So if you're putting more money down, you're financing less and your payment goes down. So
Yeah.
there also comes with, a little bit higher debt load and payment load. And there's going to be some restrictions when it comes to those programs for income levels. If someone makes lots of money, then those programs are not going to kick in because there's going to be limitations to whatever the income level is and
Sure.
or to whatever the purchase price might be as well. So again, it's picking up the phone and calling and see what's available. Oftentimes, I do find people do have access to down payment and they've got a little bit of money either already saved or they maybe have access to them in some retirement accounts that allow for them to borrow against the retirement account,
Ah,
which is sometimes a much better decision than waiting to save or to do the down payment assistance programs because they're borrowing for, there's a whole bunch of positive things, but again, we got to be um, cognizant of what we're doing and why, because there's some teeth to borrowing against a 401k
yeah.
that you just need to be aware of. But so or maybe they have access to um, some family members who are willing to help give an upper hand there, and they can buy a house and maybe get a gift from a direct family relative that a direct family relative would love to be able to provide some help to get into that house. And we can look at it that way too, versus going with one of the down payment assistance programs and having a little bit higher interest rate. So it's just
Sure.
finding out what the options are and the pros and cons to those options. I'd advise my kids to be talking with someone who can just let them know all the pros and cons and help them maneuver through those decisions. And
Yeah.
there's no perfect decision as well. There's only a decision, and we go about um, adjusting things accordingly as life changes. But you make the best decision that you can, and you go on from there.
So on some of these sweetheart deals that they see advertised, just because it's available doesn't mean it's smart to do,
Right.
right? Just like,
Absolutely.
hey, I'd like to have ice cream for dinner every single night, but it probably wouldn't be smart to do, not over long periods of time. So
Right.
just kind of to come back to where we started, the notes I'm taking. three things that the buyer needs. They got to have credit. And it doesn't have to be as good as they think. Typically, you could buy a home with a 580, but preferably more about a 620 and or higher. And to give you an
Yeah.
idea, I mean, perfect is all the way up to 850. So if you're at 620, you can go buy a house. You shouldn't be thinking, I can't do this. And you won't know if you can do this until you talk to somebody like Jared, who can tell you what your credit score is. The second thing is you got to have income. And if my notes are right, about 1/3 of your income can go to housing, and that is your principal, your interest, your taxes, your insurance, your HOA, and that if that's 30% of your income, well, okay, we can live within that. And then down payment, there are a lot of programs out there, and some of them that offer really, really, I wouldn't call them aggressive, but affordable paths to home ownership are typically going to be designed for people who do not make as much money. So if we've got people out there that are high income earners, those probably aren't good options. But if they're high income earners, they should have the money to do what they want to do anyway.
Yeah.
Did I
Well,
miss
or
it?
that what they can do, maybe again, we may not, I want, like you said, to eat ice cream every night, but I'm going to get fat and have cholesterol problems, especially at my age. Yeah. So what I want to do and what is possible, are two totally different things. Yeah. So,
Sure. All right. So we've talked about they should have a conversation. They should start the ball by an investigative or exploratory process as to what is possible. And then you would help them understand what is possible, what is not. They might be ready right away, but even if they're not, at least they know where they are and they can create a plan to get to a place where they are ready to buy a home.
yep.
And
Yes.
that's not just for first time buyers, that could be for move up buyers as well. Because maybe they don't have as much equity built up in their house yet. Maybe they don't have as much cash that they need yet. But at least by having a conversation with you, Jared, they'll understand a baseline of here's where you are today, and here's the steps where you have to take in order to get where you need to be to buy that next perfect home. So it really does all start with a conversation with you. Um,
Yes.
let's talk about mistakes. Let's move to mistakes. And by the way, we're not calling out anybody in particular. If any of these mistakes sound eerily familiar to you, that is strictly by coincidence. But what do you think? Give me one, and we'll move on to others. But what's the first one that comes to mind in terms of mistakes people make?
I'd be also interested to hear what you see from your side of that equation as well. But one thing I see all the time is that talking to a mortgage professional, the analogy is not fun, frankly. I mean,
I
I wanted
love
to,
talking to you.
yeah, right. Well, great. That's awesome. But talking to someone who does what I do, I mean, it's, we're talking about usually things that are a little bit more private or just not as much fun. I liken it, like going and looking at homes and finding out what's, where you want to live is like trick or treating. Talking to a mortgage person's like going to the dentist. It's not as much fun. And so what people like to do is they say, well, I don't want to dig into this until I find the right house. I don't want to waste your time, Jared, until I know that there's going to be something that we're going to like and we're going to get excited about, and then we'll talk to you. And the challenge that happens there is that sometimes people get excited about something that's beyond their reach and they didn't know it, or um, they maybe have something going on in their financial life that had we known about just 3 months prior, we could have made some mid-flight corrections or some tweaks, and they'd be in a lot better financial position. Or what we're seeing in this market is that the right house comes along and they don't have all their financial ducks in a row and they just can't make everything happen quick enough. Or even if they do have their financial ducks in a row, they haven't gone through what does a payment look like? Can we afford it? is this, how much money that, we're going to need? What happens if we've got a house that we've got to sell? I mean, there's just all kinds of things that end up clouding the picture that had they just picked up the phone and talked about it, they would have saved themselves a whole lot of pain and anguish and heartache and indigestion. So just not doing it sooner, taking some just proactive steps is usually the biggest mistake, because they don't know what needs to be done, or they don't know what's possible. Because the other side of the equation too is that maybe they think their home is out of reach, and it may not be too. And so maybe they've compromised, and they could have done something that they didn't think that they could do. And the phone call we get is they've already made some decisions, and they're just going down that road.
Yeah. What I'm hearing, and actually I was kind of processing a lot of from my side and your side, especially. I mean, you and I have been working together for 17 years, and we've seen, we've seen a lot of interesting things. Shoot, and I'll summarize it in a moment, but here's an example. Yes, waiting to find the perfect home and not starting soon enough, but how about if somebody was under contract to buy a home and they're really excited about buying their home, because buyers are never really excited. It is literally Christmas on steroids for a buyer when they're buying a home, whether it's their first home or their 10th home. Would you agree?
Yes.
And so
Along
they
with a
get
little bit of nightmares too, sometimes. I mean, they get all excited, but then there's also the mental anguish that happens too.
Yeah, so they get really, really excited. And they're now, let's just say, 2 weeks before closing. And one of the two or both decide, let's go shop for furniture.
Yeah.
Or let's go buy a new car.
Yeah.
Which has happened to us.
Yes.
We actually had a client buy a car the week before closing.
Yes.
Are those mistakes, and why are they mistakes?
Well, yes, those are big mistakes, because, again, as we talked about, there's debt to income ratios that a mortgage company cares about. And even if they can handle those payments, so even if they can afford the car, they can afford the furniture. Yeah. Right. What happens is that when a mortgage company is doing a loan, we run a credit report, and along with that credit report, there's some monitoring that goes on with that to alert us of any new debt, because that's really important. And if that we get an alert of new debt, then that comes into the underwriting equation. And it's possible that if they get a new debt, the minimum is that we've got to go through all the rigmarole to get all that information and to get it all verified. And if they're supposed to be closing within a short time frame, that may be delayed, because we've got to get all the disclosure and all the regulatory things done. And there's nothing that we can do. And then that causes a lot of problems if things are delayed, right? I mean, that's not a fun conversation to tell the seller, hey, we're not closing, and when there's moving trucks lined up.
Yes.
And so that would be,
go ahead.
Oh yeah. So that would be the best case, is that it's just maybe more.
Best case is we're delayed. Worst case is it's off, and now earnest money is at stake and a lot of other things.
And that's possible as well, is that now you've gone over the threshold. Maybe you make more money, but if you're self-employed, you might write off a whole bunch of things that
guilty.
Yeah, right. That you have the ability to do, but it just makes the debt to income ratios a little bit different. Anyway, there's a whole host of things. So worst case scenario, you maybe now get to live in your car that you just bought. Another big mistake is that people will quit a job. Maybe they have a new job all lined up, and so they think it's no big deal. Hey, I'm going to quit this job, but I got a better job lined up where I'm going to make more money. and I get to, take some time off too. And I've got PTO part-time that I accumulate, so it's like financially, this is awesome.
Mm-hmm.
Mortgage
Not for the
side is
lender.
not awesome at all because you don't get a loan until you start that job. And maybe sometimes your compensation is something that we need to show a history of. And that's even a bigger deal. And I've had luckily I've not had a scenario where we couldn't overcome it happen, but people will quit jobs in the middle of the process and not think it's a big deal, but it's a big deal.
It is a big deal. And I'm going to interject two things here for the viewing audience. 17 years, Jared has been my only lender, and he has closed every single buyer on time without a hiccup. Every one. The guy's batting 1,000. He's going to go to the Mortgage Hall of Fame if I have a vote.
Well, I knocked on my mic, which could have been wood. I don't know if
Yeah.
that shows up, but
The second thing
right.
I'm
Well,
going to
yeah.
say is it just dawned on me, Jared, that when you were talking about the mistakes and people go out buy furniture, they go buy a car, and then the computers in the background start sending off bells and notifications that, hey, you're the borrower's doing something they shouldn't do. You're basically Santa Claus in that you have the ability to give them this wonderful present, but you're also watching to see if they've been naughty or if they've been nice.
Yeah, we
And
don't want to give
don't
a
be
lump of
naughty.
coal. Yeah, a lump of coal is no good. Right.
So I actually tell my buyers when we start this process and after they've talked to you, and the one thing that I tell them is, I don't want you to buy a pack of gum unless Jared says it's okay. You don't buy anything. Don't even a pack of gum. If you want to buy a pack of gum, you got to call Jared.
And that's
And they
one
laugh.
reason why these people do come through too, because you give sage advice. Sometimes that they can buy, go on with your overall normal financial life, right? So
Sure. I mean,
yeah,
you have to live, but I try to
yeah.
drive home the point that, right now you have to be the most perfect financial picture you can be, and that does not include spending. So, no, these are all really good mistakes. Waiting to find the perfect home, definitely a mistake. Waiting to start the process until you have found the home you want, because let's just make it as basic as I can make it. You are asking somebody who has never met you, who does not even know your parents, to give you 300, 500, a million, $2 million on a loan. They might want to do some background checking. They might want
Yeah.
some documents, like a lot of them, before they give you this giant bag of money. So understand that the process, if you have a great advisor, a seasoned veteran like Jared, the process is not scary. He will guide you. He will give you all the steps you need. And the sooner you start, the simpler, smoother, and more efficient the process will be. If you wait to the last minute, I you're not going to like the way it goes. So you're absolutely right. Start early and have all your ducks in a row before you go shopping. I think you would ask me what are the mistakes I see, and there's a number of them. One, I would say probably one of the most important things outside of understanding your shopping budget with you. And I tell people, they'll ask me point blank, hey, can we go look at homes this weekend? And I said, as soon as Jared tells you what you can afford. Well, can't we just go look at a few? No, we cannot. And because I will be doing you the greatest disservice that there is by taking you out and letting you fall in love with, for example, an $800,000 house. And then we find out that the bank is only going to loan you 600. Now you're going to base every home you see on the ones you fell in love with at 800. And every one of them will disappoint. And so I cannot let you go shopping until you know what money you have in the bank to go shopping with. The second one is when you're going through homes, do not talk about how much you love this or how much you hate this or how much you're going to change this, because it's the year 2024 and you are on candid camera. Assume you are being listened to and watched, and they will be taking notes, and the notes they take will be used against you in a negotiation, whether it's a negotiation on price when you buy it, or negotiation on inspection, or negotiation on a post-occupancy agreement. They've got you on tape, so don't talk in the house. Second, coming in too low. Yes, it is possible in today's market to buy a home below list price. There's also a number that you come in and you are going to thoroughly offend the seller. And that will come back at a future negotiation, whether it's on inspection, whether it's on appraisal, a post-occupancy agreement, personal property you want to buy from them. Just please be respectful and think about, if you were the seller, where would you want somebody to come in? If it's a house that is priced where you really don't think it's right, well, guess what? The seller's probably not coming down to your number anyway. Go find a different house. And that, along with, falling in love with a house that you can't afford. So those are some mistakes. And it all begins with talk to a mortgage professional and talk to them early and talk to them often. Let's move on to myths. All right. There are a ton, boy, the list of myths is a mile long. I think you and I would both agree, but which ones do you think stand out to you that you hear most often when you're meeting with a client?
Well, it's, we talked about it a little bit. It's the perfect credit, must have perfect credit, must have 20% down payment, must be on the job for 2 years. If someone's self-employed, there's a different standard there. I mean, myths come in sometimes for good reasons. There's something out there that someone heard and maybe just doesn't completely understand or why it applies to them. But you don't need a 2-year employment history, and that, again, the 20% down one, and people just think that they need more money down, and that mortgage insurance, because what is there is that if you put less than 20% down, you're going to have what's called mortgage insurance, which insures the mortgage company against expenses or losses if foreclosure happens. It doesn't insure the borrower that the mortgage or the payments are going to be made, or it doesn't insure them, it insures a mortgage company. And so we're more likely to lend, but it's not the worst thing in the whole wide world. And in fact, because there's been so few foreclosures and so many really well qualified people have been buying year after year after year, and property values have been going up, and there's been very little loss because of foreclosures. Mortgage insurance is cheaper than it's ever been. And
wow,
that can
you know what? I did not think about that. That makes total sense.
It's
you don't have the same loss reserves needed.
Nope. So
okay.
Yeah. So those are the biggest myths typically.
How long should somebody have a job? You said they don't have to be employed for 2 years. What's a good number?
Well, and this gets into some of the, what's required and what someone maybe should do in their overall financial life can be different. But if they're feeling like they've got a really good job, I mean, we just need them. If they're salaried, they just have to start. In some cases, they may not even need to start. It kind of depends. But basically, they would just need to start their job, be W-2'd, and we can use that income, boom, right away. So they don't, now if they've been out of the job market for a long period of time, then it's 6 months.
Sure.
But if someone just maybe graduated college and they found their job and boom, they're starting, or we could close their loan day after they start.
That is certainly not 2 years. So
no.
Here's the myth: you don't have to be employed 2 years. You could literally get a job tomorrow on a W-2, and there's a possibility, but you'd have to talk to Jared first, just like we talked about. Number two, you don't need perfect credit. You need good credit. And realistically, somewhere in the mid sixes will get it done. You do not need 20% down. You're going to get an FHA loan with, what was it, 3.5?
Yep.
How
And a
about
conventional
this one?
3.
Don't run my credit, Jared. Don't run my credit. It's going to hurt my
Oh,
credit score.
that's a huge one
Is
too.
that
Yeah.
fact?
Well, yeah, so the way it works is when any mortgage company does a loan, we have to do what's called a hard pull. We can do a soft pull, or most mortgage companies can do a soft pull, so we get an idea of what the credit score is and, perfect picture of the credit without doing the full hard pull. But if you do a hard pull, there's an inquiry that shows up, and that can affect your credit score maybe 3 points. Not much. It's pretty
Wait. So a soft pull does not affect your credit at all.
correct.
But a hard pull might bring your credit from a 650 to a 647.
Well,
I mean, 3 points
it
is
would be,
nothing.
you have still, when we pull it, it's the 650. It's the next pull is the 647. If that's pulled,
Okay.
so really it affects the future
But
score.
only by
That's
3 points.
irrelevant
Lions
because
and tigers and bears, oh
oh
my.
my, right? Yeah,
I
because
mean, 3 points
we
is
hit the score,
nothing.
and that's like if you were to pull it later. So,
And that's
and
for the hard pull. That's not even for the soft pull.
right, and
Okay.
that goes away, that recovers in about 60 days or 90 days. But then though but if you're not pulling the score, it's irrelevant. So
Right.
big deal. And
Okay.
the other thing is that when we pull score, we have the ability to do what's called a rapid rescore. So if I pull the score and say, hey, guess what? Your limit to outstanding balance is a little bit too high. You pay your credit card down by $500 and your score is going to go up by 10 points. Well, now and you're going from a 720 719 to a 720, which gets you in a different threshold, which gets you a better interest rate, which gets you blah, blah, all this stuff.
Right. Okay, there's
It's silly.
for all you viewers out there. This is a perfect example as to why Jared is our guy. He just went through an example of totally out of the box thinking to put in place one little payment to bring down a balance that then increased your credit score over a particular threshold, even if it was only 2 points away, that then brought down your interest rate. I mean, right there, that one little nugget of advice could save you thousands and thousands of dollars over the course of the time that you own the home and have the mortgage. This is the perfect example as to why Jared Hamilton is the debt advisor that we recommend to everybody, because he is looking at all the different ways to get somebody a better rate, a better payment, and increase their net worth by managing the debt the way they manage their assets. Okay, let me ask you this. There's been a lot of talk, Jared, in Washington, D.C. over the last couple of years about forgiving student debt. What if people have a student loan? Do they need to pay that off first?
Maybe not. Maybe.
Or is that a myth?
So that's the whole thing. We don't know what the situation is till we look at it. But 99% of the time, no. I mean, we allow people to have debt. And so that's part of the whole debt to income ratio scenario. And the reality is that if someone does have a lot of student loan debt, and if that isn't, hurting someone's ability to buy the house that they would want, well, but maybe they're going to have that debt. They're still, I mean, that is what it is. And so now how do we combat that in compromising somewhere else? So, but
at the end of the day, they should not think that having a student loan gets in
no,
the way of owning a home.
no.
So that is a myth, and we've busted it.
Exactly. Yes.
Okay. So basically, some of the major myths: you don't need 20% down. You
Wait, can I
don't
stop you
Go ahead.
too for
Yeah.
a second? Yeah, because sometimes again, everybody's goals can be different, but they get, I mean, and reasonably, they want to say, listen, I want to get these student loan debts paid. And I don't want, I want to allocate as much money as I possibly can in order to get these student loans paid, because I want them off the radar screen as soon as I can. And that can be, again, sometimes these can be significant and it can take a long time. But what we can sometimes do is we can show them how buying a house allows them to build equity, allows them to pay down their debt, and allows them to pay off those student loans in the future quicker, because now they can utilize some of that equity that's built up over time. And we've done this with many clients and help them build wealth, get into a house, secure what their overall living expenses is, and later on down the road, as they build equity, then they can pay off those student loan debts if that's what they want to do, with more fiscally responsible money that they can write off and things like that. So sometimes it allows people to get to that situation a lot quicker.
So just going through the myths, you don't need 20% down. You don't need perfect credit. You don't have to be employed for 2 years. You probably need less income than you think. Running credit does not hurt their credit score, and they don't have to pay off a student loan to buy a home.
Correct.
I mean, those are all myths that are out there, and they are not true. Let's move towards kind of wrapping this up for a little bit. And I wanted to specifically save this to the end. And I wanted to talk about the pre-qualifying process, because right now people have been listening and they've said, okay, you know what? Jared's got all the experience that I need. I need to have a conversation with him. I need to know what my income is. I need to know what my credit score is, and he can help me with that. I do not want to wait, because waiting too long is going to hurt my ability to make a move on the house that I really, really want. And I've now learned about all the myths. I'm ready to talk to Jared. What does the pre-qualification process look like?
Well, it can be different for everybody. It can be simply setting up a telephone call and we can go over some of these things over the phone. I'll just need to know what someone, where someone has lived the last 2 years, where they've worked the last 2 years, an idea of what, their income is, and social security numbers and dates of birth. That's it. They really don't need, a whole lot more. And, an idea of what their, where their money is, what
Okay.
something like that looks like.
So
So,
basically a ballpark guess on their assets.
yep.
So this is a phone call. They don't
Phone
necessarily
call?
have to come in and meet with you the first
Nope.
time.
Nope.
You're going to do a soft pull on their credit.
Yep.
They need to show a proof of income. And does this, by the way,
They
does
don't
this
need to show proof. They just need to tell me what it is. Yeah. So
they need to tell you and
eventually
be
we'll need to do it.
honest,
Yeah. Yeah. I
you
mean,
know?
yeah, you're right. Exactly. I mean, that
And
only hurts them. Yeah.
does this phone call cost anything?
No.
It's free. My favorite four-letter word, free.
Yes. Yes. Only
So
time.
it's and how much time do you think realistically is it's not 5 minutes? I'm guessing is it an hour? Give or
It
take?
depends upon how I like to talk, and I love to help people. So I can talk for a really long time, as you know, Wade. Our conversations go for a while because you are also liking to help people.
I am a
So
talker.
yeah, but I can do it in, 15 minutes. If people have those numbers, we can tell them what they need to know. If they want to go more in depth, I usually schedule around 45 minutes. The other thing, though, we can also do too is that people are busy and they have, a lot of stuff going on. We can send them a link and they just fill that stuff out online. I
Oh,
also will ask a couple of just financial planning questions, what someone's overall goals and objectives are and things like that, that kind of help me incorporate their mortgage into the long and
sure.
short-term financial goals. They do that. I do some homework. We set up a time and then we go over the results. And that can take, again, 15 minutes, but we can also go longer on that too, as well. So, and that's all free as well. I mean, that's
Boy,
all, there's no out-of-pocket costs. Time is money. I understand that, and so
in
there's,
this case, it's an investment. It's not
yeah,
an expense.
exactly. Exactly. Yeah.
So we started the conversation today about how the first step is to pick up the phone and talk to you about their goals and get a pre-qualification process going. they may or may not move forward on buying a house. But as we began, if you don't know, you don't know. And once you do know, you either know that you can move forward or you can create a game plan to get to a place where you can move forward. Is there anything else you'd like to add that maybe we didn't talk about today?
Well, yes. I mean,
Yeah.
regardless of whether you use me or, a big institutional bank or a credit union or what's called a mortgage broker, the reality is all these mortgages are bought and sold on the secondary market as mortgage-backed securities. Nobody can offer below market rates. I mean, this is all Fannie Mae, Freddie Mac. Um, there are differences between mortgage companies and how efficiently they're able to produce a loan and deliver it to the secondary market, and there can be some slight cost differences there, but there's not going to be a massive, at least in, I guess that's a relative term, but you're not going to, there's not going to be a 0.5% difference from mortgage company to mortgage company that's real. All these things can be based upon, what someone was just saying, if they didn't understand the full picture, if you talk to someone one day and then someone else 2 weeks ago, and there's been some rate movement that's just natural. Depends upon the program, but generally speaking, though, we're all going to the same sources, and so you're going to get different advice and you're going to get different level of expertise. But there's not going to, I mean, a massive difference between mortgage company to mortgage company, and someone's able to offer a below market rate because it's just not possible.
Right.
And does that make sense, Wade? I mean,
Yes,
what is your,
completely.
yeah.
It actually it brings up something that dovetails beautifully in how I was going to kind of wrap this up. And on a future episode of this, ladies and gentlemen, Jared and I will go through some different strategies and tactics that get used, and we'll get a little more granular. But for the sake of today, we wanted to put it out there that obtaining a mortgage, you are closer than you think to the home of your dreams, whether it's your first home or whether it's a move up home. And when it comes to borrowing, when it comes to a mortgage, as Jared mentioned a moment ago, everybody's going to the same source of funds. It's the same pool of money, and the difference in rate is going to be minuscule. The real difference maker, and I can say this after 17 years in the business, 5 years as a managing broker, overseeing 1,000 transactions a year during that time period, hundreds of transactions, Lori and I in our business, all with Jared. I can tell you the difference is not the bank. The difference is the person that's sitting in the seat, the person that knows how to ask the questions to help you make a better decision to increase your overall net worth. It's not always just about rate. It's about how do we build a loan that fits into your overall financial goals to allow you to build wealth faster and more efficiently. And that involves managing assets, which you will do on your own. But something that's overlooked by 99% of all the lenders out there is managing the debt as a debt advisor. And that, Jared, is why I regard you not just as one of my dearest and closest friends, but as truly one of our secret weapons in our business. I can tell you without a doubt, there are at least several dozen transactions that would not have happened if you weren't the guy in the chair. So, and I don't get paid to say this, but Jared is the secret weapon when it comes to our buyers. And the one thing that I'll tell you, and Jared, you don't know what I'm going to say, so just take it and enjoy it. The number one question that we get after people are finished and they've bought their home and they're really excited, and the number one question, and I ask them, what was it like working with Jared? Because we always want to know whether it's our plumber, our electrician, our mortgage guy, or our movers, whatever. I always want to know, how did our people do? And the one question we always get when we ask, what was it like to work with Jared and his team? Is he really that nice after, when he's not doing business? And I have to look him in the eye and I have to tell him, yeah, he's arguably the nicest guy that I've ever met. And I think the number one thing that leads to that is because you approach every client with an education approach. You're there to teach and educate and hold hands far more than you are to do their mortgage. And so I speak for myself, I speak for Lori, I speak for Bianca, I speak for every one of our buyers. We are so, so grateful for the level of professionalism, integrity, and discipline that you bring to this industry. Because without you, I can tell you the Perry Properties Group would not be successful as they are. So thank you for being you, Jared.
That's humbling. And
well, no,
thank
it's
you.
it's 100% the truth. Ladies and gentlemen, we had a great time today. We've talked about the steps that you need in order to start the process of getting a mortgage. We talked about the mistakes that people make. I know none of you will make them. We talked about the myths that are out there. And the only thing I'll leave you with, a homeowner has a net worth 44 times greater than a renter. If you don't own a home, now is the time. We'll address this on another podcast, but we're grateful for you tuning in and listening to us. This is Wade Perry of the Perry Properties Group at EXP, and my friend
Jared Hamilton with Cherry Creek Mortgage, Division of Guild. Thanks very much for your time, Wade.
We wish you all the best. When you have questions, reach out to one of us. By the way, I totally forgot. My mistake. Jared, how do they get a hold of you?
Well, great. Well, I can be reached via phone, 303-331-4343. I've had that number.
Can you say that again? Repeat that again.
Yeah, 303-331-4343. My website is justmyname.com, not just my name, but it's jaredhamilton.com, Jared, Hamilton, like the $10 bill.com, and happy to answer any questions that anyone might have.
Wonderful. Ladies and gentlemen, it's a great life, and thanks for watching.